Hello viewers, welcome to Income Fund Fundas, a unique show simplifying debt markets, hosted by yours truly Sunil Javeri and brought to you by Axis Mutual Fund. Interesting question by a viewer. So what is point-to-point returns and what is rolling returns? Point-to-point returns on a mutual fund scheme connotes the returns generated by a mutual fund scheme between two dates in time. For example, 1st of June 2016 to 31st of May 2021 is one particular point-to-point returns for past 5 years period. That has become an industry norm rather than an exception, but it is a post-mortem of past performance. 90% of the times the story may be behind us and it can change dramatically by tweaking the start date or the end date. Let's take this as an example. I'm going to explain to you what is the difference between point-to-point returns and what is the rolling returns, and why one should be taking cognizance of both these returns criteria to select a scheme or analyze its performance. This particular scheme, with a 1 month exit load period in a debt space, generated phenomenal returns as on 1st of June 2013 for the past 1 year, 6 months, 3 months, 2 months and 1 month, which was the point-to-point returns. And as you can see, 16%, 19%, 16%, 13% and 11% returns over 1 month to 1 year period. Naturally, anyone would be attracted to invest in a scheme like this, but if you analyze the rolling returns analysis going forward, you will realize how the story was behind us and not in front of us, and why rolling returns is the main criteria for selection of a scheme or analyzing performance of a scheme. Now let us understand what is rolling returns. Rolling returns are returns taken over a continuous period of time, particular period of returns taken at regular intervals of say 1 day, 1 month, 3 months, etc. For example, if you wanted to understand daily 5-year rolling returns from a period of 1st of April 2010 to 31st of March 2021, 1st of April 2010 and 5 years thereafter becomes the first observation. 2nd of April 2010 and 5 years thereafter, which will end on say 2nd of April 2015, will be the second period and second observations, and so on and so forth. So this will encompass the good, bad and the ugly of a scheme's performance over any 5-year period, any 3-year period or any 1 year daily rolling returns period. Now let us take forward the same example. If somebody would have invested in that same scheme, looking at that point-to-point returns analysis, which was from 16% to almost 19% in returns for 1 month to 1 year period, if somebody would have invested on 1st of June 2013 till 20th of May 2014 with an intention to hold it for any 1 month period, the returns in this on the minimum side was negative 35%, maximum return of 46% and average return of 4.68% with a standard deviation of 14.44%. 63 observations were negative out of 233 observations. Will anyone invest in a scheme like this with a 1 month investment horizon looking at this data? Answer is clearly no. As I mentioned, 90% of the times, especially in asset classes like debt, stupendous returns can be a thing of the past. It was just a post-mortem by doing a point-to-point returns analysis. Concentrate on both point-to-point returns and rolling returns analysis to analyze a scheme's performance or selecting a scheme. Hope viewers have understood the difference between point-to-point returns and rolling returns analysis and their respective importances. Thank you so much. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.